There's a lot of news that keeps coming out in the stock market, and even as a content creator, I feel like it's challenging to keep up with everything going on. So in today's video, I want to cover some of the most important events that are currently going on in the markets, and what I think about them. In this video, we will cover a new investment that Bill Ackman just made, what the Fed said about inflation and economic growth, United Health's stock having its largest one-day drop in over 20 years, Jamie Dimon's warnings to investors, and the Magnificent Seven's valuations heading into earnings season. It's going to be an absolutely packed video, so let's dive right into it. And let's start off by discussing Bill Ackman's new investment. So yesterday, it was announced that Bill Ackman took a stake in Hertz, the rental car company. This sent the stock absolutely soaring today, and it's currently up 56% on the news. However, this is a small position for Ackman, with it only making up 0.4% of the Pershing Square portfolio. So at least for now, it does not seem like this is a high conviction investment for Bill Ackman. He's also facing a lot of backlash online today because Hertz is seen as a very weak and declining business. In fact, the company filed for bankruptcy back in May of 2020, and it has not been performing well since then. If we head over to Stock Unlock really quickly, we can see that Hertz was a $35 stock in November of 2011, and before the recent pump to the share price today, the stock was down 90% from 2021 to 2025. So it saw massive losses for its shareholders. We can also see that Hertz has a stock unlock insight score of 1.58, which is extremely low. Usually when I see stocks with this low of ratings on our platform, it's a pretty big red flag. And I've never invested in a stock with this low of a rating, not even close. So let's go and take a quick look at Hertz fundamentals. And first off, let's take a look at its revenue. And here we can see that its revenue has not really grown since 2006. Its total change is plus 14% over the past 18 years. So Hertz's business has not really grown revenue in almost 20 years now. If we take a look at its net income, we can see that it has been positive, then negative, then positive, then negative throughout history. And in the most recent year, the business has lost roughly $3 billion in earnings. It was producing positive earnings in 2022, but it is now producing negative billions of dollars in earnings. This is the same story for Hertz's free cash flow, and throughout the company's entire history, it has consistently been losing billions and billions of dollars. And lastly, I want to take a quick look at their balance sheet. So right here we can see that Hertz has about $21.8 billion of assets, it has about $592 million of total cash, and about $1.8 billion of total current assets. Now, if we scroll down and take a look at their liabilities, they have $21.6 billion worth of liabilities, $4 billion of current assets, $16.5 billion of long-term debt, and $17.6 billion of total non-current liabilities. So what I'm noticing on Hertz's balance sheet is they have almost as much total liabilities as they have total assets. So this company is leveraged up with that $16.5 billion of long-term debt as well. The company's cash position and current asset position is also not very strong relative to its current liabilities of $4 billion. So the company needs to produce profits over the next year to handle its debts that are due within the next year as well. And how the company is currently handling all of its debt is it's actually selling off assets. This screenshot comes from Hertz's most recent investor presentation for the fourth quarter. And in this screenshot, Hertz says the fleet is currently in a rotation and that the business is in a transformational stage that's designed to improve its financial performance over the long term. It expects this transformation to be done by the end of 2025. And I researched and looked into this further to get some more specifics on what Hertz is actually doing. And here's what I found. Hertz is reducing its electric vehicle exposure. It has scaled back its electric vehicle investments after significant losses. The company faced a $1 billion headache from its 2021 purchase of 100,000 Tesla vehicles, driven by high repair costs, low resale values, and spare parts shortages. Hertz is now selling off portions of its electric vehicle fleet to reduce financial strain and align with consumer demand for regular, traditional vehicles. The second thing is they want to increase their fleet quality and alignment. Under the new CEO, Stephen Scherr, who was appointed in February of 2022, Hertz is focusing on aligning its fleet with profitable customer segments, such as businesses and leisure travelers at airports. This includes improving the fleet mix to reduce depreciation costs and enhance revenue per unit. And then lastly, they want to do asset retrenchment. Hertz is optimizing existing assets by selling underutilized vehicles and leveraging its used car sales network to improve liquidity and control its fleet costs. So in general, the business is selling off all of its unprofitable assets and business segments, and focusing only on the ones that actually make the company money. The management expects this to result in a return to profitability. However, in the short term, the business is going to continue losing revenue as cars and business units are sold, and it is still burning cash with a weak balance sheet in the meantime. So the only conclusion I am coming up with is that Bill Ackman is viewing Hertz as a turnaround opportunity. He is known to be an activist investor, so he must be getting involved so he can help guide the business back to profitability. He's also got a large stake in Uber now, so maybe he's thinking there can be a partnership between Uber and Hertz and these two companies in some way. But again, it's still a very small position in the Pershing Square portfolio, but at the surface, this company looks like an absolute dumpster fire. So I definitely will not be buying Hertz stock, as I think its fundamentals look like absolute trash. But it will be interesting to follow and see if this investment plays out for Bill Ackman. With that being said, let's now move on to the most important things that the Fed said about the markets and the economy in its announcements yesterday. Jerome Powell said tariffs could lead to both inflation and an economic slowdown. In this article, it says, Federal Reserve Jerome Powell on Wednesday cautioned that the central bank could face a challenging scenario of managing both accelerating inflation and a slowing economy brought on by the impact of President Trump's tariffs. In written remarks to the Economic Club of Chicago, Powell reiterated that the Trump administration's tariffs are significantly larger than anticipated. The same is likely to be true of the economic effects, which will include higher inflation and slower growth, he added. Even so, Powell said the Federal Reserve can stay patient and wait to see how tariffs and other economic policies of the Trump administration play out before making any changes to interest rates. The sharp volatility in financial markets since Mr. Trump announced sweeping tariffs on April 2nd, only to put most of them on hold a week later, has led to speculation about whether the Fed will soon cut its key interest rate or take other steps to calm investors. For the time being, we are well positioned to wait for greater clarity on the impact of policy changes in areas such as immigration, taxation, regulation, and tariffs, Powell said. So it sounds like the Fed is not in a rush to bail out the stock market or lower interest rates in any way. And I think the reason that the Fed does not want to move too quickly is because tariffs are probably going to be an inflationary force, especially in the United States. So we could see an uptick in inflation due to tariffs. And if the Fed was going to lower interest rates into rising inflation, then that could only accelerate inflation potential, because lowering interest rates is an inflationary thing to do. So what I think the Fed wants to do is see how much inflation is going to be caused from these tariffs and how much economic weakness is going to be caused as well, because they need to do this balancing act where they want to help out the economy, but they don't want to cause inflation to run away from them. That's kind of why they're waiting to see what happens. And I agree with the Fed here. And if you guys have been following the news lately, Trump is trying to tell Jerome to lower interest rates. Trump is very clearly saying, hey, it's time. You've been historically very slow to respond to what the economy is doing. And Trump is saying, Jerome, get in front of this and start lowering interest rates right now. However, the Fed's job is to stand up to the president and really just wait and see. And I personally think that Jerome is doing the right thing. And I think that he's actually a very good Fed chairman. Because again, his entire job is to stand up to the president, focus on the data, and do what is best for the overall United States economy. And I think that there is a real risk here that if Powell lowered interest rates into tariffs, we could see massive inflation in the United States, which is not his goal. Jerome is also saying that the Fed is being placed in a tricky situation where the economy is slowing down, but inflation is rising. This is also known as stagflation. And the reason that it is tricky for the Fed is because they want to help the economy by stimulating it by lowering interest rates. But if inflation is rising, then again, they cannot lower interest rates to help out the economy. And what this ultimately means is that if the economy does slow down, then the Fed may not have as much power or as many tools to bail out the economy and stimulate the economy. So if we do see some sort of recession plus higher inflation, then it's going to be one where we're going to just kind of have to ride it out, and the Fed is not going to have too many tools to help us out. And this will be the first time that this has happened since before the 2008 financial crisis. Because since 2008, it seems like every single time the economy slows down or a recession looks like it is going to come, the Fed just plows money into the economy and cuts interest rates down to zero, and then we push off the recession until later. So it seems like people are worrying that the next recession could actually be a true recession where we see the economy slow down for a couple of years. And honestly, investors such as myself who started investing within the past 10 years have not actually seen or lived through a real recession. And as an investor, I'm actually kind of hoping that we do, because if we do see a recession, then maybe prices of the stock market will come down to offer investors and net buyers of stocks much better prices. So that's actually kind of what I'm hoping for selfishly as an investor. I don't want anyone to lose their jobs, but recessions are part of the economic machine. We're going to go through them. And, if we do go through them, then I hope that we can just take advantage of it the best way that we can, because it's out of our control. And when things are out of our control, the best thing that we can do is use the situation to benefit us as much as possible and take advantage of the opportunities that come. And that's what I'm going to be focused on my channel if we do actually see a slowdown in the economy. What's also interesting is inflation expectations are now sitting at their highest point since 1981 and are absolutely spiking. So people are expecting inflation to get worse with all of the new tariffs that Trump has announced. And again, if we do get a weakening economy into higher inflation, then the Fed won't be able to bail us out this time. Yesterday, Jamie Dimon also urged the US administration to discuss a trade solution with China. And here this says, Jamie Dimon said President Trump's trade war risks eroding the US's credibility and implored the White House to initiate talks with China, according to an interview with the Financial Times. Dimon described the uncertainty over tariffs as challenging, adding that he wants the US to begin negotiating with allies. His comments come as the World Trade Organization warns that the outlook for global trade has deteriorated sharply. This next screenshot also shows that earnings revisions have been coming down at the fastest rate since COVID. This basically means that analysts and businesses are lowering their earnings outlooks at the fastest pace since the pandemic. This is a result of Trump's tariffs and the global uncertainty around the economy right now. Jamie Dimon has also been selling a lot of shares of JP Morgan. Over the past few weeks, he sold a total of $72 million worth of shares, which is roughly 20% of his entire holdings of JP Morgan. As the CEO of one of the largest banks in the world, it's pretty interesting to see him selling so many shares at the same time as he's voicing concerns about the global economy. Jamie also had an interesting quote during the JP Morgan Q4 earnings call. So let's take a quick listen.
What I would say is our excellent economist, Michael Feroli, I called him this morning specifically to ask them, with how they're looking at their forecast today. So they think it's about 50-50 for a recession, so I'll just refer to that. Obviously, if there's a recession, credit losses will go up, and other factors will change too. And I think the one thing I'll add to what Jeremy said is, and I don't usually pay that much attention to anecdotes, but this time I am. And I think you're going to see a lot of companies, you guys, not you, but the analyst community has already reduced its earnings estimates for the S&P by 5%. So it's up 5 as opposed to up 10. My guess is that'll be 0 and -5 probably the next month. And then you're going to hear 1,000 companies report, and they're going to tell you what their guidance is. My guess is a lot will remove it. They're going to tell you what they think it might do to their customers, their base, their earnings, their costs, their tariffs. It's different for every company, but I assume you'll see that. And anecdotally, a lot of people are not doing things because of this. They're going to wait and see, and that's M&A. That's M&A with middle market companies. That's people's hiring plans and stuff like that. So people have to adjust this new environment, and I think you will see what it is.
In this call, Jamie said he thinks businesses are going to remove or lower their outlooks for 2025. He sounds like he thinks the economy is weakening, and investors haven't gotten the full story yet. He's also said he's seeing companies and CEOs holding onto their cash and not wanting to invest while things are so uncertain. And I mean, think about it. If you're a CEO, why would you start a multi-billion-dollar project right now when you don't know how high tariffs are going to be or what international trade is going to look like within the next few months? The result is that businesses are pulling back their spending and holding on to their cash, which is causing the economy to slow down. This is why Jamie Dimon says the US administration needs to start working on deals and give some clarity to the markets, because the uncertainty could quite literally cause us to enter a recession. Now back to the topic of earnings revisions. United Health announced its earnings this morning, and the stock is currently down 23% at the time of recording this video. This is United Health's largest one-day drop since 1998. And many investors are now looking at this stock and asking for my opinion. So let's take a look. So I went through United Health's earnings report very quickly, and I found that the company lowered its earnings per share guidance for 2025 down to about $25 per share. Its previous guidance was about $28.50 in earnings per share for this year, so the revised guidance is roughly 10% below what the company was previously expecting in terms of earnings per share. And the stock is absolutely tanking on this news. Now, if we head back over to Stock Unlock really quickly, we can see that United Health is now trading for $452.76. And once again, the company is expecting earnings per share of about $25 in 2025. This means that based on its 2025 estimates, it is trading for about 18 times earnings today. Now, if we go and take a look at United Health's historical price to earnings ratio over the past decade, we can see that its average has been about 23.1. So as of today, based on its 2025 earnings per share guidance, it's trading well below its historical average price to earnings ratio. And this business has continued to see its revenues grow incredibly consistently. And in 2024, it grew its revenues by about 10%, and in the most recent quarter, it also grew by about 10%. So this business does seem like it is continuing to execute, but it's just seeing some short-term headwinds in its most recent earnings, and in 2025, it did lower its earnings guidance slightly. But the company is still growing, and I think that this is one of those high-quality businesses that's now trading well below its historical average price to earnings ratios, and an 18 PE does look pretty attractive for this stock. Now, I also have been reading about United Health online, and it seems like this is a very polarizing stock right now. Investors either like the business and they're willing to buy into it on this dip, or they absolutely hate the business and they literally want it to go to zero. I also think that there is potential headwinds that United Health and health insurance companies in general could face under the Trump administration, because they have made it clear that they want to look into all healthcare and kind of rework the healthcare system in the United States. I got to admit, this is a little bit out of my circle of competence because as a Canadian, I don't know the United States healthcare sector that much, and even what Trump wants to do. But I think that could be something to take a look into, especially if you're interested in United Health stock. But in general, if United Health's underlying fundamentals and business can continue to grow at around 10% annually, which is basically just maintaining their current growth rates, then I do think that the stock could be offering value today and could be looking interesting. So if you're interested in United Health, this could be a time to take a deeper look, maybe study the risks, and overall just study the business, because this is kind of the time that you want to get interested in businesses, is when their stock prices are going down. I also think that the sell-off to United Health looks a little bit unjustified, because think about it. They lowered their earnings per share guidance by roughly 10%, and the stock saw a over 20% decline on the day. And it's now trading well below its historical average price to earnings ratios. So it does kind of seem like an overreaction at face value. And I also think that this could be maybe giving us a preview into this earnings season, because if companies come out and they lower or remove their guidance, then, United Health is giving us a preview right here where the stocks could take a massive hit unjustifiably so. So in my opinion, if a company like Amazon comes out, for example, and it lowers its earnings guidance by 5 to 10%, and the stock drops 20 to 25%, then I'm definitely going to be taking a look at Amazon, or really any other stock that sees an unjustifiably large hit to its share price on an earnings revision. So that's what I'm going to be watching out for this earnings season. And based on United Health's price action today, this is also kind of what I am expecting, is large hits to share prices if anything happens to the company's guidance for 2025. And I'm going to be covering as many earnings reports as I possibly can on my channel during this earnings season. So if you are not subscribed to my channel, then I would recommend doing so if you want to stay up to date with all of the major earnings that are going to be coming out over the next week or so. With earnings coming out soon, I also quickly want to discuss the current valuations of the Magnificent Seven stocks. And I currently think that the price to operating cash flow is the best metric to value these businesses, because many of them are going through large CapEx cycles right now. So if you're looking at PE or price to free cash flow on these businesses, they're going to be extremely high because they're going through CapEx cycles, and it's not going to give you an accurate reflection of how the businesses are being valued today versus their histories. So I want to know, how are they being valued versus their histories? And right now, again, I think price to operating cash flow gives us the best indicator to that. So with that being said, let's take a look at the price ratios of all of these businesses today. Apple is currently trading for 27 times operating cash flows, and its long-term average has been about 21.7. So Apple is trading well above its historical average price ratios still, and this is one of the businesses out of this entire group that's growing the slowest. So for some reason, Apple is trading for one of the highest price multiples while also seeing the lowest amount of growth. In my opinion, this does not make any sense, and therefore I think Apple is still extremely expensive in the market. Amazon is currently trading for 16 times operating cash flows, and its long-term average has been about 26. This means that Amazon is trading well below its historical average price ratios, and this is one of the reasons why I think Amazon is looking so cheap in the markets today, and one of the reasons why I have continued to add to my Amazon position and buy the dip on this stock. But moving on, we can see that Apple is trading for 15 times operating cash flows. Its historical average has been about 18, so it is below its historical averages as well, but the discount isn't as significant as Amazon. Meta is currently trading for 14 times operating cash flows, and its long-term historical average is about 15.7. So it's also trading at a discount to its historical averages, but its discount is only about 10%. So relative to Amazon and even relative to Google, it's not offering as much of a discount relative to its historical averages. Microsoft is trading for 22 times operating cash flow, and its historical average is about 24.2. So this one is trading below its averages, but also by roughly only 10%. Nvidia is trading for 38 times operating cash flows, and its historical average is 58. So it is selling well below its historical averages, but it is still selling for a pretty high price multiple of 38 right now, and therefore this business is pricing in a lot of future growth, more so than the other businesses we're taking a look at. And then there's Tesla, trading for 52 times operating cash flows. Its long-term average has been about 57, but Tesla is currently seeing its profitability decline, its margins are declining, and I believe that its revenue is also declining right now. So I have absolutely no idea why Tesla is trading for such a high price multiple, because it's probably one of the weakest businesses, if not the weakest business in the Magnificent Seven right now, at least in my opinion. So I think that Tesla is massively overvalued. I think that it is significantly risky, and I think it's the most expensive stock in the Magnificent Seven by far. It's not even close. I think the cheapest stock, personally, is Amazon, and then it would be Meta, and then Google, then Microsoft. And I actually think that these four stocks are looking quite attractive right now. And I did a quick scatter plot chart to show us the price to operating cash flow multiple versus the 3-year expected revenue growth of all of these businesses. And this is the four companies right here. And the best way to think about this chart is you want the dot to be as low as possible and as right as possible, because the price multiple being lower means that the stock is selling for a lower price multiple, which is obviously ideal. That's what we want. And then the further right the dot is as well is the higher future revenue growth that the business is expecting, or it's what analysts are expecting. So right here, we can see that the cheapest stock, the one that is the lowest and furthest right, is Meta, trading for a 14 price to operating cash flow, and analysts are expecting it to grow by 14% annually, its revenue, over the next 3 years. Google is also trading for 15 times operating cash flows, and analysts are expecting its revenue to grow by 12% annually over the next 3 years. Amazon is trading for 16 times cash flows with 11% projected growth, and Microsoft is trading for 22 times operating cash flows with 12% annual revenue growth projected over the next 5 years. So this is why I think these four stocks are looking at the cheapest by far, is because their price multiples are quite low, and they're also growing quite quickly, or their expectations for future revenue growth are pretty decent. And you can clearly see that on this chart. There's a nice concentration in these four businesses, so their price multiples are low, and their revenue growth projections are quite high. Then we have Apple right here, where its price multiple is quite high, and its revenue growth projections are only 6% annually over the next 3 years. So it's further left on the chart, and it's much higher up. This combination suggests that Apple stock is actually very expensive right now, especially relative to these four stocks right here. Then we have Nvidia right here, where its price multiple is much higher, but its future growth rates and its projections are also significantly higher. So that higher price multiple is kind of justified by its higher revenue growth as well. You kind of want to think as if there was a line going through this chart diagonally right here. And what you want to see is the stock tickers below that line. Apple is clearly above that line, Nvidia is actually still below that line, and Meta is the furthest below that line, which suggests that Meta could actually be one of the cheapest stocks in this picture right here. Now, Tesla right here is trading for a 52 price to operating cash flow multiple. And when I took a look at the revenue projections on this business, analysts think that they're going to see 38% annual revenue growth over the next 3 years. I strongly disagree. I think that Tesla could potentially see 0 to 5% annual revenue growth over the next 5 years, which would put it way over here, okay? So its price multiple would be extremely high, and its revenue growth would be one of the lowest. And it would be very much so considered the most expensive stock here. So this is based on analyst expectations, but on my expectations, the stock is probably way over here. And that's kind of how I'm thinking about the Magnificent Seven valuations today. And you can also see why I think that these 4 stocks right here, Meta, Google, Amazon, and Microsoft, are not actually looking that expensive today. With all that being said, that is going to wrap up the video for today. And I do really hope that you all enjoyed. If you did, please leave a comment in the comment section below and let me know what you think on all of the topics that we discussed today. Also, if you're new here and you want to stick around and see more of my content, especially with the earnings season coming up, if you want to get access to all the videos that I make during the earnings season, then please make sure to subscribe to my channel as well. But with all that being said, that is going to wrap up the video, everyone. So as always, thank you all so much for tuning in. I truly do appreciate it, and I really hope to see you all again in my next one.